Have you ever wondered how significant financing deals are shaping the commercial real estate landscape in North America? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a noteworthy development in the industrial real estate sector, Advanced Realty investors and Greek real estate partners have successfully secured a substantial $300 million in fixed-rate permanent financing for their project. This financing is earmarked for 3 industrial buildings, which together span nearly 1.6 million square feet at the Linden Logistics Center in Linden, New Jersey. The financing was arranged by Cushman & Wakefield through Northwestern Mutual, marking the second time Northwestern Mutual has provided financing for this property. The Linden Logistics Center, a major industrial complex located in northern New Jersey's Port Industrial Market, is comprised of 7 buildings totaling over 4 million square feet. Buildings 300, 400, and 700, which were constructed in 2022, are part of the second phase of this development. They boast modern features such as 40-foot clear heights and configurations that support efficient logistical operations, including cross-docked and front-loaded setups, along with ample parking facilities. The industrial campus is strategically located just east of Interstate 95 and only about 10 miles from Newark International Airport, making it an attractive hub for e-commerce and logistics companies. This prime location facilitates last-mile distribution solutions, a critical factor in today's supply chain operations. Currently, the Linden Logistics Center is 94% leased to prominent tenants, including Samsung Electronics America and OCM Globe. Notably, Vanguard Logistics is leasing the entirety of Building 400, while other major leases include Wynit at Building 700 and Fabuwood Cabinetry at Building 300. This high occupancy rate underscores the robust demand for Class A industrial space in the region, particularly in the Port of New York and New Jersey area. According to Cushman & Wakefield's first quarter market report, while the overall New Jersey industrial market saw a slowdown in leasing activity earlier this year, the Port region and Meadowlands submarkets have demonstrated occupancy gains. This is largely driven by strong demand for newly delivered Class A properties. These submarkets alone accounted for over 35% of total leasing activity in the first quarter, highlighting the strategic importance of these locations in the industrial real estate sector. Overall, the transaction by Advanced Realty investors and Greek real estate partners highlights the ongoing demand and strategic importance of well-located industrial spaces. As developers shift towards build-to-suit projects, the market may see a healthier balance, setting the stage for continued growth in the coming years. Stay tuned as we continue to explore more pivotal developments in the commercial real estate landscape. Dallas-based Carbon Companies has initiated the final 2 stages of a significant luxury multifamily project near the Professional Golfers Association of America in Frisco. This development, known as the Links at Professional Golfers Association Parkway, will introduce 620 podium-style luxury units, 815 underground parking spaces, wellness facilities, and resort-inspired amenities. The first 2 phases of the project were completed in December 2021 and October 2023. Once fully realized, the project will encompass 1,310 units. This groundbreaking follows Carbon Companies securing a $125 million loan in April to fund the project's final phases. In a notable shift within the office real estate market, the removal of office space is set to outpace new construction this year, as per a recent report by CBRE. The report highlights that in 2025, an estimated 23.3 million square feet of office space will be either converted to other uses or demolished across 58 major markets in the United States. This marks the first time in 25 years that removals will surpass new office space deliveries, which are projected to total only 12.7 million square feet. CBRE's analysis reveals that both demolition and conversion activities have accelerated since the pandemic, with over 81 million square feet of office space currently planned for conversion or already in the process. This trend accounts for approximately 1.9% of the total United States office inventory. Despite these changes, office vacancy rates have remained steady at around 19% in the first quarter of 2025. The momentum for converting office spaces has been building over the past decade, with an average of 58 office conversions annually since 2018. In 2024 alone, 94 conversion projects were completed, totaling 13.1 million square feet. This year, CBRE anticipates around 68 projects will be finalized. By 2027, conversion projects could total more than 60 million square feet, driven largely by the demand for multifamily housing, which comprises about 76% of these projects. The conversion of office space to other uses, such as hotels, life science facilities, and industrial properties, varies based on factors like building configuration, values, inventory age, construction costs, and the availability of experienced developers. Manhattan leads the nation in office space conversions with 10.3 million square feet, followed by Washington, D.C. at about 9.2 million square feet. Cleveland stands out with the highest share of its office inventory undergoing or planned for conversion at 8.4%. Converting outdated office buildings plays a crucial role in revitalizing urban centers, although not all structures are suitable candidates. Many office towers from the 1970s and 80s present challenges for conversion into multifamily housing due to their large floor plates, which hinder the ability to create units with sufficient windows and natural light. Consequently, these older buildings make up more than half of demolitions, but only 35% of conversions. In North Texas, a notable advancement in commercial real estate sustainability has emerged, according to a report by Nora Dathia from the Dallas Business Journal. The region is experiencing a surge in the adoption of a state-level financing mechanism aimed at supporting energy-efficient upgrades in commercial properties. This initiative is designed to simplify the process for property owners to access long-term, fixed-rate funding, which is essential for implementing green building improvements. This development comes as some environmental initiatives encounter obstacles, making the availability of such financing tools even more critical. The program's increasing popularity among North Texas officials underscores a broader commitment to sustainability within the commercial real estate sector in the area. The initiative is part of a growing trend in North Texas to enhance the sustainability of commercial real estate, reflecting a larger movement seen across various regions, including parts of Canada like Kitchener-Waterloo, London, and Cambridge, Ontario. These Canadian areas are also focusing on sustainable development by incorporating energy-efficient practices within their commercial real estate projects, thereby aligning with the cross-border trend towards greener real estate solutions. In the evolving landscape of commercial real estate, grocery stores are emerging as a critical component of mixed-use developments, filling a unique niche that complements multifamily living and retail spaces. According to Adam Blair's recent article, despite economic uncertainties impacting other real estate sectors, retail continues to exhibit resilience with a low vacancy rate of 4.1%. Grocery brands like Aldi, which plans to open 800 new stores by 2028, are at the forefront of this trend due to their robust growth and low closure rates. These grocery stores are increasingly finding their place within mixed-use spaces that combine residential and retail elements. A report from JLL indicates that the retail sector will see the opening of over 7,700 new stores between 2024 and 2025, including 917 grocery stores, which is a leading growth rate, with 15 new grocery stores opening for every closure. This indicates a strong demand for grocery stores as part of mixed-use developments, despite their traditionally expansive layouts. The trend towards integrating grocery stores into mixed-use developments is driven by a need for smaller, more community-focused formats. These stores, which often adopt a neighborhood market style, are designed with reduced footprints and fewer parking spaces, catering to local residents within walking distance. This approach not only meets the needs of the community, but also enhances the appeal of mixed-use projects by providing essential amenities that draw foot traffic and support residential components. Some grocery brands are already experimenting with this personality approach, creating stores that emphasize quality over quantity, offering a local or farmers market feel. This strategy aligns with the interests of mixed-use developers and investors who are primarily focused on residential opportunities, as these grocery stores act as attractive street-level venues that enhance the value of the property and serve the local community. High-end grocery brands like Erewhon have successfully implemented this strategy by establishing themselves in residential mixed-use environments, serving both as a convenience to residents and as a draw for the surrounding neighborhood. Despite the challenges of reduced stock space, these stores have thrived by focusing on high-quality, local, and organic products, thus offsetting the need for wide-ranging options. This evolving model of grocery stores and mixed-use developments not only addresses the current vacancy challenges, but also provides a pathway for grocery brands to expand into denser urban areas. By adopting smaller, more adaptable formats, grocery stores can successfully integrate into mixed-use projects, benefiting from the synergy between residential and retail components. As we observe these trends, it is evident that the integration of grocery stores into mixed-use developments is a strategic move that addresses both market demands and urban development challenges. This approach allows grocery brands to tap into new markets and demographics, while also supporting sustainable and community-oriented urban growth. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.